This short video provides an outline and some motivation for the study of macroeconomics, which is the last part of this course. Macroeconomics covers the whole economy. And first, before we get into macro, let's talk a little bit about the micro we have just covered. So microeconomics is about individuals and how they make economic decisions. It's about firms and how they make economic decisions, and in fact, industries, which is where we went with the market structure. Microeconomics, if you look at it carefully and how it was developed, it unfolds beautifully. In macroeconomics, it unfolds a little differently, but the big picture of macroeconomics and what macroeconomics is designed to do is pretty cool. We'll talk about the business cycle, which is the short run. We'll look at potential output, which is the long run. We'll study gross domestic product, which is output. And if you recall from the circular flow diagram, somebody's income equals somebody's expenditure in the overall economy. So we'll work off of that. We'll look at price indexes to measure inflation. We'll look at money supply and the Federal Reserve System, a very important component. We'll look at aggregate demand and aggregate supply, and that's where really the big picture comes into play analytically. Then we'll discuss briefly fiscal policy, which is actions by the federal government to stimulate the economy, and monetary policy, which are actions by the Federal Reserve to manage the economy. So what do I mean by managing the economy? The business cycle representing a short-run phenomena, potential output representing long-run output. What does that mean? Well, I can tie it all together in a picture that summarizes our motives for studying macroeconomics. Here's the picture that I'm referring to. History shows that the economy wiggles up and down over time. It has a long-run growth pattern, as you can see, and I'll draw it right up the middle here. And so what you see deviations from the red line. Deviations from the red line are what we call the business cycle. There's what's called booms and busts. And when we're above the long run trend, we're in an economic boom. People tend to lose their degree of risk aversion, meaning they tend to almost gamble in terms of their economic decisions. Inflation tends to ramp up. We get stock market bubbles, we can get real estate bubbles, we can get commodity bubbles. Sometimes we're all referred to as asset pricing bubbles from too much speculation, and that ties back to the risk aversion concept I just referred to. And so that's when we're on an upswing. And when we're on an upswing, those bubbles tend to burst. The stock market bubble, real estate market bubble, the excessive leverage that people take and the excessive speculation all comes to a crash often. And when it comes to a crash, we go well below the line and we go into a recession. And recessions are filled with pain. It's unemployment. And so our goal here in macroeconomics is to be able to understand the overall economy, the business cycle, and how to straighten out that wiggly line so we follow the red line. The economy and the people in it would be so much better off if we could just have reasonably strong, steady growth. So, again, the business cycle is those short-run deviations from the red line. Those deviations to the red line are considered short-run deviations. As you can see, they last for several years. And I didn't really put a time dimension to this graph, but most of those cycles last several years before they flip over into start another cycle. Now, what we're talking about with fiscal and monetary policy is, for example, can the federal government increase its spending when we're in a recession to bring us back to that red line faster than what would normally happen in the economy? And so before we go into that, let's back up a second and say, what happened to the economy before the federal government got in the business of trying to straighten out the economy, and the Federal Reserve, which came into play in 1913, which they're often trying to manage the economy also. What happened to the economy before that? Well, there's self-correcting mechanisms that we'll talk about, so that when we go into an economic expansion, the economy tends to revert back to its long-run trend, and we go into recessions, things adjust, and we tend to go back again to the long-run trend. But the point of macroeconomics is to understand the economy. And if we understand the economy well enough, and we get into an economic boom or a recession, maybe we can steer it back to the red line a whole lot faster. Imagine if we can get the economy back to long-run trend way faster when we're in a recession. People would be unemployed a lot less, and probably the recession would be a lot more shallow if that was the case. So you can see we would be all a lot better off. Now that red line is called long-run potential. We can't really measure that, but we impose the historical average of GDP into the graph. The economy grows on average about 2 to 3%. Real growth, that excludes the inflation effects, and we'll cover what the inflation effects are. And the other thing that's important about this is if we can smooth out all of the wiggles that are in the economy, maybe, just maybe, we can increase the trend for economic growth in the long run, which is an interesting idea. Can we increase the trend so that we're all better off? And not only that, but before we look into that question, we need to better understand what drives long-run potential, so that while there's a lot to it, it really boils down to labor productivity growth. So that's the key to understanding our long-run economic prospects. And we'll be looking at that when we study macroeconomics.